Hello everyone and welcome. I'm excited to have you here today. We're about to dive into a comprehensive overview of ETFs, exploring how to invest in them, highlighting top picks, and examining key considerations. The presentation is titled ETF Exchange Traded Fund 2026 Guide, and over the next few slides, we'll cover all the essential aspects you need to know. So let's get started and look forward to a productive session together. An ETF, or exchange-traded fund, is essentially a basket of securities. These can include stocks, bonds, or commodities. What makes ETFs interesting is that they trade on stock exchanges just like individual shares. So you can buy and sell them throughout the trading day, just like regular stocks. In India and around the world, you can access ETFs through your demat account and stockbroker platform. It's a straightforward way to invest in a diversified set of assets without buying each security individually. When considering which ETFs to buy in 2026, it really depends on your personal investment goals. For long-term growth, broad market ETFs like the Vanguard S&P 500, also known as VOO, or the SPDR S&P 500, often called SPY, are popular choices. If you're focusing on the Indian market, ETFs like Nifty BeES are also worth considering. Ultimately, selecting the right ETF aligns with your financial objectives, whether that's broad exposure to the market or a focus on specific regions. An ETF, or exchange-traded fund, is essentially an investment fund that you can buy and sell on stock exchanges, just like individual stocks. It holds a variety of assets, such as stocks, bonds, or commodities, which helps diversify your investments. One of the main features is that it trades in real time throughout the day, giving you the flexibility to buy or sell at any moment when the market is open. ETFs often track an index, like the Nifty 50 or the S&P 500, which means they aim to replicate the performance of a specific market segment. This makes them a convenient way to invest broadly without having to pick individual stocks yourself. They usually have lower expense ratios compared to mutual funds, making them a more cost-effective option for many investors. Another key point is transparency. ETFs disclose their holdings regularly, so you always know exactly what assets you're invested in. Plus, they tend to offer good liquidity, meaning you can buy or sell shares fairly easily without impacting the price too much. For example, in India, we have Nifty BeES, which was launched in 2002. It tracks the Nifty 50 index, giving investors a simple way to invest in the top 50 companies listed on the Indian stock market, just like tracking a market benchmark. Overall, ETFs are a versatile and efficient way to build a diversified investment portfolio, combining the benefits of stocks and mutual funds in one package. Let's start by opening a demat and trading account with a reliable broker. In India, popular options include Zerodha, Growa, and ICICI Direct. Once your account is set up, you can search for the ETF symbol you're interested in, like Nifty BeES, a gold ETF, or even something like VOO if you're looking at US markets. When you find the ETF, placing a buy order works just like buying any other stock. You select the quantity, confirm the price, and execute the order. You have the flexibility to hold onto ETFs for the long term or sell them whenever you choose, whether that's intraday or after holding for months or years. It's important to be aware of the costs involved. You'll pay brokerage fees for each trade, plus a small expense ratio that usually remains below 0.5%. Overall, buying ETFs is straightforward and provides a simple way to diversify your investments. Whether you're looking for quick trades or long-term growth, understanding these steps helps you make informed decisions and stay aligned with your financial goals. Let's take a closer look at some of the key ETFs to consider in 2026. Starting with the Vanguard S&P 500, or VOO, this ETF provides low-cost, diversified exposure to large-cap U.S. stocks, giving you a broad stake in the U.S. economy. Next is the SPDR S&P 500, or SPY, which is known for being the most liquid ETF globally, making it a very flexible choice for investors. Moving on to Invesco QQQ, which tracks the Nasdaq 100. This ETF is heavily weighted towards the tech sector, offering strong exposure to innovative and high-growth technology companies. Now, shifting gears to India, there's the Nifty BeES, which tracks India's top 50 companies, giving you a solid representation of the Indian market. Alongside that, the SBI ETF Nifty Bank focuses specifically on the banking sector within India, providing targeted exposure to Indian banks. And finally, we have gold ETFs like Nippon India Gold ETF. These are excellent hedges against inflation and currency risk, especially during times of economic uncertainty. All of these ETFs reflect different regions and sectors, aligning with the broader theme of diversification and strategic investment in 2026. Choosing the right ones depends on your specific goals, risk appetite, and market outlook. When we talk about market risk, it's important to understand that ETFs tend to mirror the ups and downs of the index they track. So, if the index goes up or down, the ETF generally follows suit, which means your investment moves in tandem with the market's overall performance. Next, there's liquidity risk. Some niche ETFs, especially those that focus on very specific sectors or regions, might have low trading volumes. This can make it harder to buy or sell shares quickly without affecting the price, so it's something to be aware of if you're considering investing in less popular ETFs. Then we have tracking error. While ETFs aim to replicate the index's returns, there can sometimes be slight differences. These could be due to management fees, transaction costs, or the way the ETF is constructed, so the returns might not be exactly the same as the index. Finally, for global ETFs like VOO or QQQ, currency risk becomes significant. Fluctuations between the INR and USD can impact your investment returns. Even if the underlying index performs well, adverse currency movements can reduce your gains or increase your losses. Overall, understanding these risks helps us make more informed decisions and manage our expectations when investing in ETFs. So, when thinking about long-term wealth building, I recommend considering ETFs like VOO, SPY, or Nifty BeES. These funds give you broad exposure to the overall market, helping you grow your wealth steadily over time. They're great foundational investments because they track major indices and tend to be less volatile than individual stocks. If you're looking to tap into the tech sector and want some growth potential, QQQ is an excellent choice. It focuses on the leading tech giants and offers a way to participate in the technology boom. Just keep in mind that tech can be more volatile, so it's good to balance it with other investments. For safety and risk mitigation, gold ETFs are a solid option. Gold has historically been a hedge against inflation and market downturns. Including gold in your portfolio can help protect your wealth during uncertain times. And if you're interested in India-specific opportunities, the SBI ETF Nifty Bank is a smart pick. It focuses on the banking sector in India, which can benefit from the country's economic growth and financial sector expansion. Overall, these recommendations are about diversifying your portfolio across different asset classes and sectors. They align with the theme of building wealth thoughtfully and managing risk effectively. Alok, since you're deeply engaged in modernizing ICT infrastructure and strategic planning, ETFs can be a structured way to diversify your portfolio. Would you like me to prepare a step-by-step investment checklist tailored for Indian investors, including aspects like tax treatment, SIP versus lump sum investments, and access to global ETFs? This could help you make informed decisions and optimize your investments according to your specific goals and circumstances. Final note for you, Alok. These strategies are designed to complement your ongoing initiatives and ensure your portfolio remains resilient and adaptable in a changing market landscape.